David Burrows is here from Barometer. We're talking about North American large caps. We're going to grab an email right out of the gate here. This one's from Colin on JP Morgan writing, I hold shares of JP Morgan and have a target price of $45. Would your guest consider this a reasonable target?
Sure. Look, Colin, we try not to pick targets. So we try to identify key themes and companies with situations that are good getting better. And, you know, in the case of financials, they are a group that certainly are helped by QE because we know that QE is making its way to the banks. It's just not actually getting through the banks into the real economy. But JP Morgan, as a leader in this group, is in a pretty good position to win some market share by way of loan growth, which is hard to come by. And they've got a really strong balance sheet. And they covered their dividend very nicely. So if you had to own banks, and we have a small component in banks, JP Morgan would be one that I think is very reasonable to own. I think you could expect them to reinstate their share repurchase, and I think you could see some dividend growth there. But I like to own things that are doing well in the current environment, not hope that things will get better. And I think JP Morgan sort of fits into that camp.
Now, because you don't do target prices, let's talk about that upward trajectory that you look for in an equity, because I pulled up the earnings estimates on my Bloomberg screen here, and the revisions continue to go higher. So the street sentiment seems to be improving. Can we use that as an indicator for the equity movement?
I think that you want to see two things in anything you invest in. You want to see fundamental characteristics based in numbers that show something's getting better. But you also want to see price characteristics that support the view. In other words, if the fundamentals are doing this and the share price is doing that, perhaps you should assume that maybe you might be missing something. So I think in this case, you've got good numbers, you've got positive price performance. It's in a group that people seem to care about at this point. I think that you've got the wind at your back.
All right, Colin, thanks for the email. Julie in Surrey, good morning. Thanks for holding. Welcome to Market Call.
Hello, gentlemen. My question is about Apple. Would you recommend to buy now and hold or no? Thank you.
Okay. Right. So, Julie, this may be an unpopular answer. We've been in Apple a few times since initially in 2003 at $16. So this is one that we've spent a lot of time on. We use stop losses on all of our positions. And very often, share prices run up into catalysts or into good news and then spend some time consolidating after the fact. I think it's really important to watch the way Apple's behaving right now because this has been the leader in the market. This is the bellwether. And as Apple goes, you know, it can have a big impact on market, which is why I think S&P 500 has behaved so much better than many of the other indices.
Well, let's look at Apple on a one-year view because from that top, it's already down 9.7%.
Right.
Technically a correction.
Right. So our view is that this is not constructive behavior. We've sold our position, and it's not to say that we wouldn't go back. But in what has been a decent market over the last few weeks, it's been underperforming. It certainly had a big run up into the announcement of the iPhone 5. And it does have very good numbers, but I think that there is some risk in it. It's sort of priced for perfection, and we've just chosen to go somewhere else with our capital.
What price would you get back in?
Frankly, what I would want to see is it trade to a new high. You know, if it's able to hold this correction and turn and make a new high, then probably there's another leg higher. All
right. Julie, thanks for the call from Surrey. We're staying there for Jim. Hi, Jim.
Hi, Michael. David, what would be your, for Tim Hortons, what would be your entry point and your stop loss? Thank you.
Well, here's a situation where the fundamental characteristics are quite good. Their dividend growth has been excellent over the last 5 years. Not a significant dividend, but it is not behaving the right way. So I would say that just from a price perspective, this one looks like it's vulnerable. And I think there's actually quite a few companies that look vulnerable at this point. You know, we are seeing the lowest correlation of price behavior, security to security, that we've seen in a few years, which is positive. It means you can, you know, pick good ones and, you know, you can even consider being short some ones that aren't so good. I think Tim Hortons is a bit on the bubble here, and I would stay clear based on the way it's behaving.
Well, I see that the 50 fell below the 200-day moving average in early September. The MACD, the momentum indicator, is turning south on us as well. So it looks like near term there's going to be a lot of pressure on Tim Hortons. At what point would Jim consider picking it up? Do you need to see the chart turn around?
Again, I would like to see, we look for how is a security behaving on a good day? Is it participating? and how is it doing on the weekdays. And over the last while, Tim Hortons has really not been making any headway on the good days, and is giving up more than its share on the down days. So I just think I would want to see better behavior in the share price before I'd be an enter.
Jim, thanks for the call from Surrey. Before the break, let's squeeze in Natalie from Toronto. Thanks for holding, Natalie. Welcome to Market Call.
Hi. I'd like to ask about American Capital Agency. I've been watching it, and I'd like to know what would be a good entry point, if it's a good time to purchase, and also how much the dividend is. So thank you.
All right, $33.19 today, and the dividend, according to my Bloomberg screen, is 15%.
Yeah, Natalie, as you may know, there are a whole series of mortgage REITs in the U.S. which invest in mortgage bonds, many cases on a leveraged basis. And in the case of American Capital Agency, they invest in government-guaranteed bonds, many of them issued since 2008, so the lending standards have been higher. You know, in the event that you thought that long-term rates were likely to back up, then this is not the rate group to be in. At this point, we would assess that the little backup in long-term rates is more corrective than a shift in direction. I think this group provides something that everyone's looking for, which is yield. You have to recognize, you know, there is risk in this. It's not a short-term bond. But having said that, I think this is the type of camp that investors are focusing on, places where they can get a yield, places where there is some quality. This is a very well-managed mortgage REIT. And, you know, as long as you understand, if you believed that long-term rates were going higher, you would want to step away from these. I don't think that that's the case. And I think, frankly, this whole group of securities probably provides a pretty good entry point right now. All
right, Natalie, thanks for that from Toronto. A quick break. When we come back, more of your questions for David Burrows, president of Barometer Capital Management. We're talking North American large caps. There's a line available at 1-855-326-6266. When we come back, we'll find out if Canada's biggest bank is a buy.